Okay, so today we're actually going to do shipping. Like I told y'all, shipping is one of the topics that is going to come out in the exam. So for your examples, I will start doing your tutorial questions. So it'll be easier for y'all to actually understand as I explain to y'all. All right. Now, shipping is one of the companies or one of the industries that are known as specialized industries. So what is actually a specialized industry? A specialized industry means that income is taxable on world scope basis. Now, all the while under Section 33, under Section 3, you studied that income is only taxable under territorial basis, all right, which means that income will only be taxable if it's derived, accrued, or remitted in Malaysia to Malaysia. Derived in Malaysia, accrued in Malaysia, remitted to Malaysia. Only then that income will be subjected to tax. That is a territorial-based tax. Now, with the exception of certain industries, which is banking, insurance, airlines, and shipping, these are known as specialized industries. Specialized industries means that the income is taxed on world scope basis, not territorial basis, which means that if income is derived in Malaysia, then it is taxed in Malaysia. If income is derived outside Malaysia, but it is related to Malaysian activity, then it is taxed in Malaysia. If income is earned outside Malaysia or derived outside Malaysia, remitted to Malaysia, and then it will be taxable in Malaysia. Now, just to explain this point to y'all, let me just give you an example. Now, say you buy a ticket. You want to travel to, say someone from London, UK, wants to travel to Malaysia. All right, so they buy a ticket. When they buy the ticket, they would buy a ticket from London to Malaysia and Malaysia back to London because they are living in London and they're visiting Malaysia. All right, so they would actually buy a two-way ticket. They would actually buy the ticket in London. So technically the income is derived in London. Say the ticket price is 5,000. All right. Now, say the ticket price is 5,000. So from London to Malaysia is 2,500. From Malaysia to London is 2,500. Again, they bought the ticket in London. So income is deemed derived in London. Correct? Okay, so now let's look at it. For the 2,500, for the flight from London to Malaysia, all right, fuel for the aeroplane will take place in London. Food that they serve in the aeroplane will take place in London. Cleaning, baggage handling, it will take place in London. So the whole total cost of 1,400 is cost incurred in London. So this cost was incurred in London. So remember your matching concept, revenue should match cost. So when this cost is incurred in London, this revenue of 2,500 should be London's revenue because the cost is incurred in London. So this 2,500 is deemed to be incurred in London, deemed London's income, taxed in UK. Fair enough, guys? Do you all understand? Now, from Malaysia to London, say the ticket price is 2,500. All right. Now, when the plane leaves from Malaysia to London, you have to put petrol. That petrol was put in Malaysia. So the cost was incurred in Malaysia. There'll be food supplied in the aeroplane. This food was supplied in Malaysia. So this cost was incurred in Malaysia. Baggage, handling fees, check-in fees, the counters are in Malaysia. So the cost was incurred in Malaysia. So this 1,400, the cost was incurred in Malaysia. So if the cost was incurred in Malaysia, this 2,500 should be Malaysian income to cover the cost that was incurred in Malaysia. So although the income was derived outside Malaysia, because when you bought the ticket, you bought it in London. You did not come to Malaysia and buy the ticket in Malaysia. You bought the ticket in London. Remember, when you bought the ticket, you bought a two-way ticket, London to Malaysia, Malaysia to London, and you paid 5,000. However, this 2,500, although it was paid in London, the income was incurred outside Malaysia, but it is related to a Malaysian cost. So therefore, this income is deemed to be a Malaysian income taxed in Malaysia. That's what it means. Although the income is incurred outside Malaysia, but if it's related to a Malaysian activity, then it is taxable in Malaysia. Do you guys understand? Any question? Guys, any question? Do you all understand this concept? All right, so that's why this industry is taxable on world scope basis. Technically, because the income can be derived in any part of the world, but it is related to Malaysian activity. Now, for shipping companies, we need to look at two aspects. One, for a resident company. A resident company, I will explain to you later. For a resident company, the tax impact will be based on whether it's a Malaysian ship or a non-Malaysian ship. We will look at this shortly. And we can also look at non-resident companies. For non-resident companies, there is two tax methods. One is the 5% method, and one is the ratio certificate method. So we will look at this shortly. Any question, guys, before I move on? Okay, so let's look at a resident company first. Now, I told you a resident company, the tax impact will be based on Malaysian ship and non-Malaysian ship. So how do we differentiate between a Malaysian ship and a non-Malaysian ship? So for a ship to be considered a Malaysian ship, all right, the ship must be registered under the Malaysian Shipping Ordinance. The ship must be registered under the Malaysian Shipping Ordinance. Now, remember, this is a resident company. I don't need to find out whether you are incorporated in Malaysia, whether it's a resident company. I've already established the fact that you are incorporated in Malaysia, you are a resident company. But I am looking whether your ship is a Malaysian ship or it's a non-Malaysian ship. All right. So if it's a Malaysian ship, then it must be registered under the Malaysian Shipping Ordinance. The ship must be either transporting cargo or passengers. Or the ship can be also you can also rent out the ship on a time charter. Time charter meaning from this time to this time. How many hours, how many days, how many weeks. So it's on a time basis. Or you may actually rent out your ship on a voyage basis. That means I rent out my ship for you to travel from Malaysia to Singapore and back to Malaysia. That's a whole voyage. All right. So it can be a transporting ship, transporting cargo or passengers. It doesn't matter as long as the ship is under the Malaysian Shipping Ordinance. Or you can be renting out the ship on a time charter basis or a voyage business basis. Now, when we are talking about a ship, it does not include ferry, barge, supply vessels, and fishing boats. All right. Your slides has a lot more. So all those does not fall under ship. So it does not qualify as a Malaysian ship. All right. Now, why is it important for us to separate a Malaysian ship and a non-Malaysian ship? Because a Malaysian ship gets an exemption from their statutory income. The Malaysian ships gets an exemption from their statutory income. The exemption is 70% of the statutory income will be exempted. This will flow into an exempt account to be distributed as exempt dividend. It will flow into an exempt account to be distributed as exempt dividend. Now, the balance 30% is deemed total income. So what do you mean when you say it's deemed total income? This income will automatically be subjected to tax. You are not allowed to deduct anything from this 30%. So no other deductions is allowed against that. So you cannot deduct your current year losses. You cannot deduct donations and whatsoever. Total income, this deemed total income flows directly into your chargeable income. So this 30% will automatically be subjected to tax. Only 70% of the statutory income will be exempted. Now, capital allowances, you can only deduct capital allowances for a Malaysian ship against a Malaysian ship. You can only deduct capital allowances for a Malaysian ship against a Malaysian ship. You cannot deduct capital allowances for a Malaysian ship against a non-Malaysian ship. All right? The same thing goes for losses. Current year losses can only be deducted against that 70% exempt income. If you don't have enough of this 70% income, then you will carry forward the losses to be deducted against that next year's 70%. So remember, your losses, although they are current year losses, you can only deduct it against your 70% exempt income. You cannot deduct it against your 30% income. Remember, your 30% flows directly into your chargeable income. So you cannot minus anything against this 30%. If you don't have enough 70%, you carry forward your losses as brought forward losses to be deducted next year, also against your 70% income. All right. Now, because of the fact of this exemption, you get this 70% exemption, you must maintain separate accounts for Malaysian ship and non-Malaysian ship. You cannot put it together. So a resident company must have two sets of accounts, one for Malaysian ships, one for non-Malaysian ships. All right. Any question, guys? Guys, any questions? All right. Non-Malaysian ship, no exemption. 100% of the non-Malaysian ship will be taxable. That's why we emphasize the fact that separate accounts need to be kept, because non-Malaysian ship is a separate source of income. Malaysian ship is a separate source of income. So you must maintain separate accounts for Malaysian ship and non-Malaysian ship. All right. Capital allowances for non-Malaysian ship can be only deducted against non-Malaysian ship. So if you have more than one non-Malaysian ship, you can pull it together and deduct capital allowances, but it must be deducted against the total of non-Malaysian ship. You cannot take your capital allowances for non-Malaysian ship and deduct it against your Malaysian ship. It must be kept separately. So remember, capital allowances for non-Malaysian ship can only be deducted against non-Malaysian ship. Capital allowances for Malaysian ship can only be deducted against Malaysian ship. Now, losses. Current year losses can be deducted against the aggregate income of a non-Malaysian ship. Any unutilized current year losses can be carried forward and deducted against statutory income of all non-Malaysian ships. All right, this is your normal condition of deduction for losses. Any question, guys? Guys, any question? Okay, now let's look at it. Let's see whether this vessel is a Malaysian ship or a non-Malaysian ship. Vessel was registered in Hong Kong. Please remember, it's registered in Hong Kong. So it's not registered in Malaysia. Registered in Hong Kong, it's a resident company. It's a seagoing ship, transportation of cargo. However, because it is registered in Hong Kong, this becomes a non-Malaysian ship. It becomes a non-Malaysian ship. Now, this vessel is registered in Malaysia, resident company, transportation of cargo. Then, because it's registered in Malaysia, it's a Malaysian ship. Now, although it's registered in Malaysia, it's a non-resident. So this will be carrying passengers, shipping activity, but this is non-applicable. So you cannot say it's a Malaysian ship or non-Malaysian ship. This will be under the 5% or ratio certificate method. Why? Because this company is a non-Malaysian. So Malaysian ship and non-Malaysian ship does not apply here. All right. Now, this ship is registered in Malaysia, resident, but it's a supply vessel. All right. Transportation of cargo. So what do you think? What do you think, guys? Can this qualify for Malaysian ship or non-Malaysian ship? Guys, I'm asking you all. Malaysian ship or non-Malaysian ship, guys? It's a supply vessel, guys. Non-applicable. Not considered. So it's not applicable. Guys, do you all understand? Should I stop
Understood.
recording? All right. Now let's look at your tutorial question 2. Ship Lines Sdn Bhd is a Malaysian resident company. So if it's a resident company, you automatically know that you have to deal with Malaysian ship and non-Malaysian All right. Two of their seagoing ships, vessel A and vessel B, are registered under Malaysian Shipping Ordinance. So vessel A and vessel B is a Malaysian ship for transporting of cargo. The third vessel, vessel C, is registered in Hong Kong. So you know vessel C is a non-Malaysian ship. So you have freight income from transporting cargo. All right, 600, voyage charter 200 for vessel B, and freight forwarding charges for vessel C. Then you have your operating expenses, repair and maintenance, crew expenses, fuel and docking expenses. Docking expenses is when the ship docks in the port, like taking the goods out of the ship, putting the goods into the ship. All these are docking expenses. So all these four is a deductible expense. Obviously, you know depreciation under Section 39 is a non-deductible expense. Salary, allowance and wages and other operating expenses fully deductible are deductible expense. And then they have given you your capital allowances here. All right. Explain the scope of income tax that applies to Malaysian resident shipping company. Explain the scope of income tax that applies to non-resident shipping company. Compute your chargeable income and exempt income for ship line Sdn Bhd for YA 2021. All right, guys, I'm going to share the screen for you all to look at the answers. All right. Now, you have to remember a resident company, the scope of charge is world scope, which means that income derived in Malaysia, taxable to Malaysian tax, income derived outside Malaysia related to Malaysian income, taxable in Malaysia. Income related to Malaysia does not matter where the income is raised, it will be taxable in Malaysia. All right. For income not related in Malaysia, but sent back to Malaysia, remittance basis, foreign income. For now, all right, if it's a company, this no longer applies. All right, sorry. Foreign income exempted, related to dividend income only. Please remember, for a company, Para 28 Schedule 6 is only applicable to dividend income. All right, only applicable to dividend income. Other incomes remitted back to Malaysia is subjected to tax. Para 28 Schedule 6 is not applicable to any other income. Right? All right. So remember, for a resident company, I need to look at Malaysian ship, because Malaysian ship, 70% of the statutory income is exempted. 30% will be deemed total income. For a non-Malaysian ship, the whole statutory income will be taxable. All right. So if you're looking at Type of income, shipping income for a non-Malaysian ship, taxable 100% under Section 54 World Scope. For a non-shipping income, for shipping income for a Malaysian ship, 70% exempted, 30% deemed total income, also world scope, guys, also world scope. Non-resident, you have to be careful. But resident, even though it's a non-Malaysian ship, world scope, guys, it's world scope. It's not territorial basis. Non-shipping income is territorial basis. Whatever derived in Malaysia will be taxable in Malaysia. Non-shipping income derived outside Malaysia, all right? Non-foreign income derived outside Malaysia, remitted, taxable. Not remitted, out of scope. All right. Here, except for dividend income, except for dividend income. If it's remitted, then it will be taxable in Malaysia. All right. Now, non-resident company, the question asked, right? Resident company and non-resident company, correct. So non-resident company, scope of charge is of course still world scope for income related to Malaysia. If an income is not related in Malaysia, then it is out of scope. But for an income that is related to Malaysia, it doesn't matter where the income was raised, as long as it's related to Malaysian activity, it will be taxable in Malaysia. For income not related to Malaysia, remitted back to Malaysia, out of scope. Doesn't matter because you're a non-resident company. So even though you send the money back to Malaysia, it's not considered foreign income because you are a non-resident. So it's out of scope. All right, there's a difference here. For a resident company, foreign income, taxable in Malaysia if it's remitted. For a non-resident company, remitted back to Malaysia, it's out of scope. Please remember that, guys. All right. Malaysian income derived in Malaysia obviously is taxable 100%. Section 54, world scope. Non-Malaysian income, territorial basis. Only if it's derived in Malaysia, that it will be taxable in Malaysia. All right. So when you're talking about non-shipping income, this could be ground transportation, selling of products, souvenir products, all this is non-shipping income. All right. Shipping income is basically what you derive from your shipping activity. Non-shipping income, like you see, you go to Air Asia and you're traveling in Air Asia, sometimes they sell you their t-shirts, their caps, their model planes. These are all non-shipping income. All right, non-airlines income. Airlines and shipping, they are about the same. All right, so ground transportation, if you dock in, say you dock in Malaysia, Port Klang, then they take you around for a tour around KL or Shah Alam. So the ground charges for the tour, the transport charges for the tour, the food while you are on the Malaysian ground is considered non-shipping income. All right, that is territorial basis. That means whatever is derived in Malaysia, only then it will be taxable in Malaysia. Non-shipping income, foreign income derived outside Malaysia, not derived in Malaysia, even though remitted, it's out of scope. It won't fall into your Section 3 of your Income Tax Act. All right. So for non-resident, like I said, you have two taxing method, the 5% method, and the ratio certificate method, which we will look at it shortly. All right. Now going to the question. Okay, guys. So your net profit before tax is vessel A is 180,000. Vessel B, there's a loss of 115,000. And vessel C is a non-Malaysian ship. So these two are a Malaysian ship. Vessel A and vessel B is a Malaysian ship. All right. And vessel C is a non-Malaysian ship. So we cannot combine them together. It has to be separate. Now, you add back your disallowed expenses, depreciation, 30,000. Guys, please look at your question. All right. The rest of it is all allowable expenses, so you don't need to add back. So you have an adjusted income of 210. Now, vessel B, you have a loss. You add back your depreciation. You have an adjusted loss of 105,000. Remember, you cannot show a negative figure. So when there is a negative figure, your adjusted income now becomes 0, becomes nil. So this now is noted as your current year losses. This is noted as your current year losses. So your combined adjusted income is now 210,000. 210 plus 0, you get 210. Please remember, you cannot net off your adjusted income and your adjusted loss. You cannot net it off. Please remember that. You cannot net it off. All right, so 210 plus 0, you get a combined income of 210,000. Now, vessel A has capital allowances of 50,000. Vessel B has capital allowances of 10,000. Now, since both of these are Malaysian ships, remember, Malaysian ship is considered one source of business income. It's considered the same source of business income. So because it's the same source of business income, you can now combine your capital loss, your capital allowances. You can combine your capital allowances to deduct against your adjusted income. You can combine your capital allowances to deduct against your adjusted income. So your combined capital allowances is 60,000. Giving you a statutory income of 150,000. Okay, so 150,000, 70% of it is your exempt income. 70% of it is your exempt income. All right. So this 70% flows into your exempt account. This 70% will flow directly into your exempt account. All right. Now, 30% is deemed total income. So your 30% will now directly flow into your chargeable income. Your 30% will flow into your chargeable income to be automatically taxed. All right? To be automatically taxed. Now, that is for your Malaysian ship. Your non-Malaysian ship, you have 5,000 income. You add back your disallowed expenses, which is your depreciation, you have 15,000 adjusted income. You have 15,000 adjusted income, less your capital allowances, you will have a statutory income of 13,000. Remember, 100% of this is taxable because it's non-Malaysian ship, no exemption. Non-Malaysian ship do not have exemption. 100% of it becomes taxable. So 100% of your non-Malaysian ship's statutory income, which is 13,000, plus the 30% of your Malaysian ship total income, your chargeable income is 58,000. This 58,000 will be subjected to Malaysian. All right, this 50,000 will be subjected to Malaysian tax. Do you follow, guys? So the whole 58,000 is subjected to Malaysian tax. Your non-Malaysian ship's statutory income plus the 30% deemed total income, the 58,000 will be subjected to Malaysian tax. Now, what about this 105,000? Remember, I told you all this 105,000 is your current year losses. This 105,000, now, if you see, you need to minus it against your exempt income. You need to minus it against your exempt income. So you have nothing here to, all right, you have nothing to distribute as exempt dividend. You have nothing because I have 105, 70% of it is 105. I have 105,000 current year losses. I have to, I don't have a choice. I have to minus it against my exempt income. So I have nothing left in my exempt account to distribute as exempt dividend. My whole current year losses, I have utilized. I have utilized my whole current year losses. I got nothing carried forward. All right, I've utilized my whole current year losses. Do you all understand or not, guys? Okay, that's how you would actually do your relationship. Okay, I'll do question 4 with you all before I go on to non-resident company. SL Sdn Berhad is a Malaysian resident company. So again, if you're talking about Malaysian resident company, then you know I am looking at the moment you see resident company, you should know it's Malaysian ship and non-Malaysian ship. Immediately, you need to know that. You don't have to think about anything else. The moment you see resident company, first thing comes into your mind, Malaysian ship, non-Malaysian ship. All right. The adjusted income and capital allowances are as follows.
Miss, you're not sharing screen.
So you have for year 2020, ship 1, ship 2. So if you look at the word exempt here, it clearly says they are Malaysian ships. All right. So ship 1 and ship 2 is Malaysian ship. Ship 3 and ship 4 is non-Malaysian ship. So you got an adjusted loss of 800,000, capital allowances of 500,000, adjusted income of 3.5 million, and capital allowances of 700,000. 2021, you have an income of 1.3 million and capital allowances of 300,000. Losses of 500,000 and capital allowances of 400,000. Ship 3 and Ship 4 is non-Malaysian ship. So you got income of 500,000, capital allowances of 120,000. Income of 400,000 and capital allowances of 108,000. Income of 400,000 and capital allowances of 112,000. Income of 450,000 and capital allowances of 110,000. Compute the chargeable income and exempt income for SL Sdn Bhd for the year of assessment 2020 and 2021. All right, guys. Guys, are you all following? Is there any questions? Or have you all just left your one on and just gone missing?
All clear, Miss.
Okay, let's look at 2021. Sorry, 2020 first. Now, Ship 1 and Ship 2 are a Malaysian ship. So they are deemed to be a single source. And Ship 3 and Ship 4 are non-Malaysian ships. So they are deemed to be a separate source. So for this company, you have got two sources of income, source 1 and source 2. Source 1 is Malaysian ship. Source 2 is non-Malaysian ship. Now, your adjusted income for Ship 1 is a loss, 800,000. So this 800,000 is deemed to be your current year losses. This 800,000 is deemed to be your current year losses. All right. So your adjusted income will be stated as nil, stated as zero. Remember, I always told you all, tax cannot have negative figures. Tax department's not going to pay you back. So tax cannot be a negative figure. So it will be zero. So when it is a zero, you cannot claim capital allowances technically. So if you're looking at it as a separate source, you cannot claim it. All right. Now, Ship 2, you have an income of 3.5 million. So your combined income, because they are the same source, you can have a combined income. Because they are the same source, you can have a combined income. So your combined income is 0 plus 3.5, you get 3.5 million. All right. Because they are a same source, you can utilize both your capital allowances from Ship 1 and Ship 2 against your combined income. You can use it against your combined income. So capital allowances for Ship 1 is 500,000. Capital allowances for Ship 2 is 700,000. So you have 1.2 million. All right. So you have now a statutory income of 2.3 million. Out of this, 70% is exempted. So when you exempt 70%, this 70% would automatically flow into an exempt account. Would automatically flow into an exempt account. All right. Now, the 30%, remember, is deemed total income. If it's deemed total income, it will flow directly to become your chargeable income. You cannot minus anything from it. It will be totally your chargeable income. All right. Okay, now let's look at Ship 2. Sorry, Ship 3. Ship 3 and Ship 4 are non-Malaysian ships. So they can be considered as the same source because they are both non-Malaysian ships. So you can have a combined source because they are both the same ship. Unlike just now's question, vessel C was all by itself because it's a different source. Vessel A and B, you could combine them together because they were a Malaysian ship. So these two are Malaysian ships, you can combine them together. These two are non-Malaysian ships, you can combine them together. So Ship 3 got 500,000 adjusted income. Ship 4 got 400,000 adjusted income. So combined adjusted income is 900,000. Ship 3 capital allowances is 120,000. Ship 4's capital allowances is 108,000. So you have a combined capital allowances of 228,000, giving you a statutory income of 672,000. The whole 672,000 is subjected to tax because these are non-Malaysian ships, and being non-Malaysian ships, 100% of their statutory income is subjected to tax. So in total, the 100% of source 2, which is your non-Malaysian ships, statutory income 672, plus your 30% of source 1, your Malaysian ship, 690,000, plus together your chargeable income is 1.362 million, because they are subject, this is what will be subjected to your Malaysian tax. Now, let's look at your exam account. I have 1.61 million in my exam account. Sorry. All right. I have nothing brought forward. I have nothing brought forward. Now, remember, I had a current year loss. And what's the rule? I must minus my current year losses against my exam income. I must minus it. I don't have a choice. So after minusing my current year losses, I have 810,000. This whole 810,000, I can distribute it to my shareholders as exam dividend. So I have nothing carried forward. Now, please remember, shipping income has no 5 years limit. As long as you have a balance in your exam account, you can distribute it as exam dividend to your shareholders. Forever. Forever. There is not like Pioneer Status and ITA, you only have up to 5 years. There is no holiday period for shipping companies. 70% of their statutory income is exempted from tax forever. Forever. All right, there is no time limit. So because there's no time limit, shipping companies will usually distribute their exam income on a yearly basis. Unlike Pioneer Status and ITA, they'll wait for the 5-year holiday period and then distribute it. But shipping company has the ability to distribute it on a yearly basis. All right, guys. Now let's look at 2021. Ship 1 now has an adjusted income of 1.3 million, whereas Ship 2 now is making a loss. Oh, sorry, I haven't actually finished this part. I could utilize my whole losses to be minus against my exam income, so I have nothing left to carry forward. So in 2021, Ship 2 now has a loss. Again, the adjusted income of Ship 2 will be 0 instead of a negative figure. This 500,000 will be deemed your current year losses in 2021. It will be deemed your current year losses in 2021. All right. Now, because they are of the same source, you can combine them together, giving you 1.3 million plus 0 gives you a combined adjusted income of 1.3 million. You have 300,000 capital allowances for Ship 1 and 400,000 capital allowances for Ship 2. So in total, because they are the same source, you can combine your capital allowances, 700,000, to be deducted against your adjusted income, giving you a statutory income of 600,000. 70% of your statutory income is 420,000. This 420,000 will now directly go into your exam account. This 420,000 will directly go into your your exam income. Remember, the 30% is deemed total income. It directly goes to be calculated into your chargeable income. You cannot minus anything from it. Now, ship 3 and ship 4 are non-Malaysian ship. Again, they are a separate source, but both of them belong to the same source 2, so they can be combined together. So you have adjusted income of 400,000 and 450,000, giving you a combined income of 850,000. Capital allowances of 112,000 and 110,000, giving you a total capital allowances of 220,000, giving you a statutory income of 628,000. Remember, non-Malaysian ships, 100% of the non-Malaysian ships are subjected to tax. So 100,000, the whole amount, 628,000 will be subjected to tax. Plus the 30% deemed total income from source 1, Malaysian ship, your total chargeable income for 2021 is 808,000. Now, look at it. You have 420,000 in your exam account, but you have 500,000 current year losses. So in this sense, I cannot minus my current year losses in full. I can only minus 420,000 because what is in my exam account? What is in my exam account is basically just 420,000. All right. What is in my current account is just 420,000. So this 420,000, I will now minus it against what's in my exam account. So I have zero balance. If I have zero balance, I cannot distribute anything to my shareholders. So in 2021, my shareholders will not get any exam dividend because I have nothing in my exam account to give my shareholders. This 800,000 So the 80,000, you will keep it. Next year, when you have something in your exam account, then you will minus these 80,000 against your exam account. It will always be minused against your exam account. All right, guys? Any question, guys? Guys, please understand that since I'm doing these questions now, your tutors will not be doing it with you. So if you have a question, please ask me now. If not, you can actually go back and look at your questions and ask your tutors if you don't understand what I've explained to you, or you can ask me too. All right. Now, let's look at non-resident. Non-resident companies. These are non-resident companies, meaning that they are not incorporated in Malaysia, or they could be incorporated in Malaysia. They did not meet up the residency rules, so they are non-resident in Malaysia. All right, they are deemed non-resident in Malaysia. So non-resident companies are also taxable under your Income Tax Act. All right. So, like I said, shipping income derived in Malaysia, you will be subjected to Malaysian tax. Shipping income derived in Malaysia, obviously, you'll be subjected to Malaysian tax. All right. Non-shipping income derived in Malaysia, subject to Malaysian tax. Now, income not derived in Malaysia, not subjected to Malaysian tax. Now, when I talk about shipping income, please remember, shipping income derived in Malaysia and related to Malaysian activity. All right. Shipping income derived in Malaysia as well as, because remember it's world scope, Now, if income is not derived in Malaysia, it's out of scope. All right, not taxable in Malaysia. Now, because it's world scope basis, double taxation agreement will always apply here. So if the double taxation agreement has emphasized or stated something, then that information must be utilized when you're calculating the tax. All right. Now, for non-residents, there's two methods of calculating your tax. One is the 5% method. The 5% method is the easiest method. You just take 5% of gross Malaysian income, all right, and you will tax whatever answer you get here. This answer you will be taxed at the Malaysian tax rate, the prevailing Malaysian tax rate. So right now the prevailing rate is 24%, so you'll be taxed at 24%. All right, very simple. Now, the ratio certificate method uses a formula to determine your chargeable income. Now, unfortunately, this formula is not given to you in the exam, so you need to remember it. So it's world adjusted income minus world capital allowances. Sometimes it will be stated as world depreciation. All right, so depending on what the question says, both of it is the same meaning, times by gross Malaysian income over gross world income. All right, now whatever answer you get here, whatever your answer from here, again, it will be taxed at the Malaysian prevailing tax rate. The prevailing rate right now is 24%, so it will be taxed at 24%. Now, in order for you to use this method, all right, what is needed is that the acceptable ratio letter must be issued by the tax authority where the company is a resident company. So say the company is a resident company in Hong Kong for this year of assessment. Hong Kong's tax authority must issue the acceptable ratio letter. In the acceptable ratio letter, it will state what is your Malaysian gross income. It will also state what is your world gross income. So all the information that you need to use to calculate that should be stated in your ratio letter. World capital allowances, and your world adjusted income. All right. It will also tell you what is the tax that is suffered in that country. So it will actually tell you whether, and for this tax suffered in in the resident country, you will have to refer to the conditions in the double taxation agreement. So, for example, if they say whatever tax suffered in Hong Kong, 50% of it has to be discounted for Malaysia before you pay tax in Malaysia, then I have to respect whatever is in the double taxation agreement. Now, if the double taxation agreement says we are going to use a unilateral treaty, then I have to use the unilateral treaty. If they say I'm going to use the bilateral treaty, then I have to use the bilateral treaty. I am talking all this with the assumption that you guys still remember what is a unilateral treaty and what's a bilateral treaty, because you would have studied that. All right, a unilateral treaty is where when we don't have a double taxation agreement with any countries, half of the tax suffered in that country will be exempted for us when we are calculating our tax. A unilateral treaty is when we use, a bilateral treaty is when we calculate the tax, whatever tax that is suffered in that country will be allowed as a deduction against the tax that we are going to suffer in this country. Now, if you guys are still confused about it, I will ask Ms. Logis for the slides and I will upload it for you all. Now, when we are calculating what is our Malaysian income, when we are calculating what is our gross Malaysian income, we have to take into consideration casual calls, all right? And we need to take into consideration transshipment. So what is casual calls? Casual calls are when a ship docks in Malaysia. All right, we call it call in Malaysia. So when it docks in Malaysia. Now, it's called a casual call because the ship had no intention to dock in Malaysia. I only docked in Malaysia because I had no choice. It's not because I wanted to dock in Malaysia. I docked in Malaysia because I had no choice. My engine had some problem. So Malaysia's port was the nearest port. So I docked in Malaysia for them to repair my engine. So while they're repairing my engine, all right, it's considered that the period I am in Malaysia, whatever income is supposed to be Malaysian income because I'm using Malaysian facilities. However, all right, because it's a casual call, I had no intention to dock in Malaysia. I only docked in Malaysia because I had no choice, all right? That income will be exempted, will not be taxed in Malaysia, provided the ship should not dock in Malaysia within the next 24 months. If the ship docks in Malaysia within the next 24 months, then the second call will not be deemed casual call. All right. Now, transshipment. Transshipment is the income is exempted in Malaysia. Why? Because the ship is not docking in Malaysia for the purpose of generating revenue. The purpose the ship docked in Malaysia is merely to transfer goods from one ship to another ship, or from the ship to the aeroplane, or from the aeroplane to the ship. So I'm docking there to receive goods that has been transferred from the aeroplane. So I'm just there to pick up the goods, or I'm there to drop off the goods so that they can put it into the aeroplane, or I'm there just to transfer my goods from one ship because I'm not going in that route. So put it in another ship. So as far as the Malaysia is concerned, you did not transact in Malaysia. Malaysia was just an intermediary. So therefore, any income derived from the goods are exempted from Malaysian tax. Do you all understand, guys? Any question, guys? I've been talking for the past 1 hour. Is there any questions? Guys, is there any questions? Let me see whether I can do an example with you for casual call. Okay. Now, the first call was on, this is from your slides, guys, 15th of August, 2008. All right. Next call was 30th August, 2008. So 15 August, '08 to 14th August, '09 is 12 months. Ngam 12 months. 15th August, '09 to 14th August. 10 is another 12 months. So you have 24 months and 16 days. So this is more than 24 months. So this is a casual call. And this obviously will be a casual call. All right, look at the third one. September 2012. So 30th August 2010 to 29th August 2011 is 12 months. 30th August 2011 to 29th August 2012 is 12 months. So here you have 24 months, 22 days. So this one will also be a casual call. Now, fourth one, 29th September 2012 to 26th March 2013 is how many months? Huh? About 6 months. More or less is about 6 months. So what happened here is this will not be a casual call. So this will be taxed in Malaysia. This will be taxed in Malaysia. Okay, guys, question. Okay, let's look at question 1. In your tutorial, Crown Pacific Line Limited, a shipping company resident in Australia. So when it says it's not resident in Australia, you clearly know it's not a Malaysian resident company. So it's a non-resident shipping company. Derive a gross freight income of 760,000 from Malaysia. So this is gross Malaysian income for the year ended 31st December 2021. Under the double taxation agreement between Australia and Malaysia, income derived by Enterprise of Australia from the operation of ships in international traffic must be taxed in Malaysia, but the tax chargeable in Malaysia on the income shall be reduced by the amount of 50%. So your double taxation agreement, your DTA, clearly says that whatever tax you are imposing in Malaysia, 50% exemption should be given because your agreement clearly states that. So you need to respect that agreement. Compute the Malaysian tax payable by Crown Pacific Limited for year of assessment 2021. Now your gross Malaysian income is 760,000. So your taxable Malaysian income will be 760,000 times 5%, you get 38,000. This 38,000 is your chargeable income. Your Malaysian chargeable income. All right, your 38,000 is your Malaysian chargeable income. So tax on your Malaysian chargeable income is 38,000 times with your prevailing rate of 24%. You get 9,120. You get 9,120. Remember, your double taxation agreement clearly states that 50% of the tax must be exempted. So 9,120 times 50%, 4,560 must be exempted from tax. So end of the day, tax payable in Malaysia is only 4,560. Are you all clear, guys? This is how the 5% method works. Now, question 3. A vessel registered in Hong Kong. Registered in Hong Kong. All right. So this is also a non-Malaysian ship. A non-Malaysian ship owned by Moons Sales Limited, a non-resident shipping company, derived the following gross income from Malaysia. Now, date called at Port Klang, 2nd, 2017, first call, 400,000. All right. Second call is 3rd May 2019, 1 million. So between the first call and the second call is 24 months. So exempted from tax. All right. Now, third call, 5th 8 2019, 6 million. Date between second and third call is less than 24 months. So second and third call will automatically be taxed in Malaysia. All right. Now, the acceptable certificate issued by Hong Kong tax authorities in respect for year-end 2019 contain the following information. Gross world income 178.5 million. World adjusted income 158 million. Tax depreciation is the same as your capital allowances, 152 million. Assuming that the basis for the year of assessment, compute the tax payable for the year of assessment 2017 and 2019 on the basis there is no acceptable certificate issued by the Hong Kong authorities. So part A is asking you to calculate using the 5% method. Part 2 is asking you to compute the Malaysian tax payable for the year of assessment 2019 on the basis that the acceptable certificate was issued by the tax authority. The second one is asking you to use the acceptable ratio certificate method. All right, guys, any question? All right. Now, because the first call is a casual call, all right, because the first call is casual call, then it is exempted from tax. So in 2017, the first call was a casual call. Income is not subjected to tax. Income is exempted, so no tax liability. Now, the second and third call, both is in 2019. So 2019 becomes a taxable year. All right. So you take the income from the second call and the third call, 1 million and 6 million. So you become 7 million. It becomes 7 million. All right. Now, if you use the 5% method, your gross income from Malaysia is 7 million for the second call and third call, times by 5%, your chargeable income, this is your chargeable income, all right, in Malaysia. So your tax payable in Malaysia will be 350,000 times 24%. You will get 84,000. This is your tax payable. Now, if I use the ratio certificate method, remember this is my formula, world adjusted income minus world capital allowances times gross Malaysian income over gross world income. Now, world adjusted income is given to you in the question, 158 million. World capital allowances is also given to you in the question, 152 million. Malaysian adjusted income, you already calculated here, 7 million. Over gross world income is given to you in the question, 178.5 million. So you would get your chargeable income in Malaysia as 235,294. So your tax payable in Malaysia is 235,294 times your prevailing tax rate, which is 24%. Your tax payable is 56,471. Now look at it. It's both the same year based on the same income, but you get different tax amount. Now, technically, this will be the more accurate tax payable because you are getting a certificate from your resident company verifying these figures. Whereas here you are taking an estimate and you are taxing. So given a choice, the ratio certificate method is always better. However, in order to get the ratio certificate method, the tax authorities in your resident company, in this case, the Hong Kong company, your home country, must produce the certificate. Failing which, if you do not give Malaysian tax authorities that certificate, they will just use the 5% method, even though it means a higher tax liability. This is what this question intends to show you, that this is an arbitration figure. It's an estimate figure, and this is a more accurate figure. However, most of the time, this method is used because it's very, very difficult to get this certificate. All right. Now, the ratio certificate gives assurance to the host country, which is Malaysia, that the figures are reliable because these figures are actually given by the tax authorities of the home country. All right, guys? Any question? Okay, just to wrap it up a bit. One last bit. Now, for individuals working on the ship, the sailors, the managers, the accountants, whoever it is that is based on the ship, that means they are on the ships, all right? Their work is carried out in the ship. exercising employment on the ship. That means it's not like they are 365 days in the ship. Like they are allowed to come home on holidays and things like that. But their employment is on the ship. And it has to be on a Malaysian ship. All right? Not a non-Malaysian ship, a Malaysian ship. And it must be a resident shipping company. All right? It must be a resident shipping company. All right? Those people working in the ship, although they are not physically in Malaysia, they will be considered residents in Malaysia. All right, provided it's a Malaysian ship and the shipping company is a resident company. And whatever income that they are deriving, employment income, the whole income is exempted from tax. So if you are working on the ship, your whole income is exempted from tax. All right, guys? Okay, that wraps up today's lecture. Any questions? Any question, guys? If you have no questions, you may log off. If you have questions, feel free to ask me. Thank you, guys. Thank you so much for your time.
Thank you, Miss.
Oh, guys, before you go off, I've got something that came to my attention. That many of you all are sending in your EY recording